What if I told you the rules of banking have flipped? In 2008, taxpayers saved the banks. Today, the law says the banks will save themselves by using your money. This isn't a conspiracy. It's called a bail-in, and it's the new blueprint for a $223 trillion crisis. Welcome to Wealth Architect. I'm Ben. You've heard the promises. Your money is safe. It's FDIC insured. These are the old rules. The follower is hoping for a 2008-style bailout. The architect is preparing for the 2025-style bail-in. That headline, that $223 trillion, isn't just a number. It's the catalyst. It's the reason the rules had to be rewritten. Stay with me, because today we are deconstructing the new financial blueprint, and I'm going to give you the design to make your wealth bail-in proof. I'm here with Dr. Marcus Thorne, our resident economic historian. Marcus, this is the conversation that solves the biggest problem our audience has. Is my money actually safe?
It's the right question, Ben, and the answer, unfortunately, has changed. The entire social contract of banking flipped, and most people never got the memo.
Let's start there. This is a story conversation. Let's tell the story. What was the old blueprint, and what is the new one?
The story is a tale of two crises. Blueprint 1, the past, 2008, the bailout. This is what we all remember. Banks like Lehman failed, the system froze, and the government stepped in. They used taxpayer money from the outside, to bail out the banks and make them whole. It was politically toxic, but it protected depositors. Blueprint 2, the present, today. After 2008, the politicians swore never again, we will never use taxpayer money to save a bank. So they passed new laws, like the Dodd-Frank Act.
And this sounds good, right? No more taxpayer bailouts.
It sounds fantastic, until you read the fine print. The new rule says that when a bank is failing, it will not be saved by taxpayers. It will save itself by using its own capital.
And what is a bank's capital?
First, its shareholders, their stock goes to zero. Then its bondholders. But if that's still not enough, the next in line are unsecured creditors.
And who is the bank's number one unsecured creditor?
You are, the depositor. A bail-in is the legal, pre-planned conversion of your deposits, your cash, into stock in a failing bank. Stock that is, of course, worth zero.
So the new blueprint is that the taxpayers are off the hook and the depositors are on the hook.
That is the great flip.
Okay, that is the what. That's the problem, but that's a blueprint for a future crisis. Let's talk about the agitation. Why are we talking about this now? What is this $223 trillion number?
That $223 trillion is the catalyst. It's the reason the bail-in blueprint had to be created. That number is the notional value of derivatives held by U.S. commercial banks.
In plain English, what's a derivative?
It's a side bet. It's a financial contract that derives its value from an underlying asset, like an interest rate, a stock, or a bond.
So it's not real money.
It's notional money, but it creates real risk. It's a web of interconnected side bets so large, it's 10 times the size of the entire US economy. It's a leveraged Jenga tower. In 2008, the Jenga tower almost fell. The new bail-in rule was created knowing that next time, it will fall. The bail-in isn't a plan to prevent the crash, it's a plan to manage who pays for the crash.
And the follower, the person with $500,000 in a checking account, is pre-selected to pay for it.
Correct. Which brings us to the FDIC lie.
The agitation. But I'm FDIC insured up to $250,000.
This is the sugar high of security. This is the most dangerous platitude in finance. Let's deconstruct it. The $250K is real, but it's per depositor, per bank. If you have $1 million in one bank, $750,000 of it is uninsured. That $750K is the target. That uninsured portion is exactly what a bail-in is designed to take. The fund is a fraction. The FDIC insurance fund has less than 1.5 cents for every $1 of insured deposits. It was never designed for a systemic crisis, only for a single small bank failure.
So the 223T derivative crisis is the why, the bail-in is the how, and the uninsured depositor is the who.
That is the new blueprint.
Okay, we've agitated the problem. This is the solve. This is what our audience came for. This is the massive problem. We are not followers, we are architects. We don't panic, we design. Marcus, what is the actionable bail-in proof blueprint?
This is the real wealth architect design. It's not about panic, it's about structure. There are 3 layers to this fortress. Blueprint Layer 1, the FDIC audit. This is your first move. You must stop being an accidental unsecured creditor. Go to your bank accounts. Add up your total. Are you under the $250,000 limit? If you're over that limit at any one bank, you are at risk. This is not an opinion, it's a fact.
So what do? Spread it across 10 banks?
That's the follower move. It's smarter, but it's weak. The architect move is Layer 2. Blueprint Layer 2, the asymmetric flip. This is the Howard Marks Warren Buffett move. The problem, your $750,000 uninsured cash in a bank is a 0% interest loan you're giving to a risky institution. The solution, you flip the blueprint. You take that $750,000 and stop lending it to a bank. You start lending it to the US government by buying T-bills, treasury bills.
Let's deconstruct that flip. In the bank, your $750K is uninsured, at risk of a bail-in, and earns 0%. In T-bills, your $750K is fully guaranteed by the US government, 100% exempt from any bail-in, and earns 5%.
It's the only asymmetric move. You eliminate all risk and you increase your yield. This is the definition of an architect's design.
Okay, that is the core of the fortress. What's the final layer?
Blueprint Layer 3, the X-system hedge. This is the true architect's hedge. T-bills are in the system, but what if the system itself is the problem? A small 5 to 10% of your wealth should be outside the financial system entirely. This is physical gold or silver. This is Bitcoin held in cold storage, your own keys. This is not an investment to make you rich. This is insurance against the rules themselves changing overnight. This is your fire escape.
Okay, so the blueprint is foundation, the FDIC audit, stay under 250K. Fortress, the asymmetric flip, all extra cash into T-bills. Moat, the X-system hedge, gold plus Bitcoin.
That is the bail-in proof design. Marcus, this has been the most valuable blueprint we have ever deconstructed. We've solved the massive problem, how do I protect my money from this new bail-in world?
Let's recap the great flip. The old rule, bailouts, taxpayers paid. The new rule, bail-ins, uninsured depositors will pay. The catalyst, the $223 trillion derivative Jaina Tower. The lie, your money is safe in the bank, and the FDIC myth. And the architect's solution, audit, get under 250K in any one bank. Flip, move all extra cash from 0% risk, the bank, to 5% safety, T-bills. And hedge, get 5 to 10% outside the system entirely, gold, BTC.
This isn't fear, this is design, this is architecture. Now, for the architects listening, this is the most important call to action we will ever have. What is your current bail-in risk? Have you done your FDIC audit? Are you holding uninsured deposits? Share your biggest aha moment from this blueprint in the comments below. And if you are ready to stop hoping for a bailout and start designing your bail-in proof fortress, hit that like button, subscribe to Wealth Architect, and share this video. You could literally save a follower's life savings. Next episode, Hook. We've told you what to do and why. Next week, we're doing the architect's how-to, a step-by-step visual blueprint on how to buy a UST bill today and pull your money out of the bail-in trap. You will not want to miss that. Thank you for tuning in.